Jeff Christian joins us today. He is a managing partner of the CPM Group. We'll be talking about his economic outlook, updates to his outlook on gold. Jeff, welcome back to the show. Thank you for being here.
Thank you for having me back.
The GDP numbers from last quarter got revised upwards. It's now 2%, up from 1.3%. This is a big jump. People are wondering whether or not this recession that everyone's talking about is actually going to come. If you look at the numbers from at least the last quarter, on the surface, things seem to be strong. What do you think?
Well, CPM Group has been saying that we expected, modest growth this year, a little bit weak growth, but that we didn't expect a recession until 2024, 2025. So what we're seeing is confirming our economic analysis that we've had for the last year or so, which was that, we would see some slowing down and some pockets of weakness and pockets of strength, but we probably wouldn't see a full-blown recession until beyond 2023. We modified that a little bit and said that you could start seeing some significant weakness in economic activity by the fourth quarter of this year. But again, we still think it's probably the probability that we're working off of is a recession in 2024 or 2025.
Significant weakness by Q4 in terms of what, Jeff?
Well, if you look at the economy right now, you have a very strong jobs market. You have pockets of strength in services, medical services, financial services, transportation. The big tech is suffering and laying off people, but smaller tech companies are doing relatively well. So you have a lot of pockets of strength. One of the things that you might see in the third quarter is some pickup in the housing market. Frankly, I'm heartened by the fact that housing prices and rental prices have actually been falling because they've risen so far, so hard. They're really insupportable in my mind. So I think insofar as you're seeing some weakness in housing prices and some weakness in rental fees, that might see some pickup in that sector, which has been one of the weaker sectors that people have been watching in their projections of an imminent recession. But by the time you get into the fourth quarter, I think that you'll see any number of those factors starting to wane a little bit in terms of strength. Employment has been very strong. It's probably going to continue to be strong. You will have problems in the agricultural sector, which are probably going to factor in more toward inflationary conditions than overall GDP. You've had a lot of weather problems from California to Georgia. You've had weather problems which are reducing the crops significantly, and that's going to have an inflationary impact on food. It already is, but it's going to continue to have an inflationary impact on food, which will limit consumer spending on non-food factors like consumer durables and consumer non-food indurables.
Let's talk about what the Fed might do next. So the probability of a rate hike by July just shot up this morning again to now 87%. Just a few days ago, it was 70-something percent. So markets, at least the futures markets, are pricing in a near certainty of a hike in a couple weeks now, Jeff. This came out in light of the PCE number that just came out today. So it declined. The core PCE, the Fed's preferred measure of inflation, rose by just 0.3% in May. Year on year, it's up 4.6%, so slightly down from last year, or last month's reading, rather. So not quite at their 2% target. In fact, far from it. So this number, some would interpret, is actually quite hawkish for the Fed. What do you think?
I think it's a mixed picture, and again, inflation is one of those things. Inflation is a combination of factors and trends, and what the Fed does very well is disaggregate that. So you're seeing food prices high. Again, you have weather issues limiting it. You have also had a number of other issues in terms of the food distribution network and all. You're seeing food prices high. You're seeing energy prices, at least the petroleum prices, coming off, petroleum products. So gasoline and heating oil are off. I think the fact that the overall inflation rates continue to decline, I don't think that anybody reasonably thought that they would shoot drop to 2% by now. The idea that you were going to see a slow reduction over a period of several years, I think has been the common expectation, at least among mainstream economists. And that's sort of what you're seeing. However, there are these pockets of inflationary pressures. Food is one, transportation's another one, housing's a third one, although you're starting to see weaknesses there. So you have reasons for the Fed to maybe think that if it can, it might tighten a little bit more. And the employment data, the unemployment data, and some of the other economic figures, first quarter GDP revision upward, flash indications on the second quarter GDP, which seems to be doing pretty well. There are factors in the economy that suggest that the Fed might well ratchet up rates another 25 basis points. And that's being reflected in market expectations.
Could the Fed do anything from now until the end of the year that would exacerbate your recession outlook by 2024? In other words, push it forward?
Well, I think if the Fed is more aggressive than we expect, and the Fed has said, one or two more interest rate hikes, 25 basis points each, one in July, maybe one later in the third quarter. If the Fed is more aggressive than that, then I think that would raise the prospects of a recession sooner rather than later. I think I've said this to you before. We're much more concerned about fiscal policy than we are about monetary policy, and the potential for fiscal policy restrictions and cutbacks having a greater impact on the real economy, supply of goods and services and demand for goods and services. I'm not sure obviously if the Fed raises interest rates more than 50 basis points over the course of the second half of this year, that might be worrisome to us in terms of imminence of a recession. But again, it's sort of expected. And if they did raise those interest rates, it's probably because you're going to be seeing stronger economic activity than they anticipate and than we anticipate.
Yeah. So maybe a dovish Fed might actually signal weakness in the economy, is what you're saying?
Exactly.
Okay. Speaking of fiscal policy, do you think it's likely that the government will cut back on spending the year before an election, or even into the election year?
I don't think so. Not voluntarily. The CBO came out with its updated projections for government spending and deficits, and they actually have the deficit spending rising next year. That's their analysis of current existing legislation and government spending projections. So I don't necessarily see a further contraction. But you have to understand, when we were in 2021 and we had a very strong economic recovery coming out of 2020, and you had inflation rise starting in March of 2021 and continuing into June of last year, when you saw that, you had like a $3.7 trillion deficit. It's now down to $1.7 trillion for the current fiscal year. So you've had a big withdrawal of fiscal stimuli. It's not necessarily that we expect to see more of that, but what we do expect to see is we don't expect to see the kind of largesse that we had in 2020, 2021.
Mm-hmm. In your gold yearbook, you had called for inflation to soften. So far, you have been correct in that call. You've also highlighted a few risks of higher inflation, so things that could potentially boost inflation. I'll just read the bullet points so we can comment on any number of these. So the Russia-Ukraine war, the pandemic, sporadic supply constraints, example, poultry and eggs, inflation in the services sector, and a resilient labor market. You've tied resilience in the labor market with the services sector. Let's talk about that first, because I think that is one of the areas of the CPI print that have been more resilient. Why is it that the service sector, at least from an inflationary perspective, hasn't softened yet?
I think part of it is the fact that, you have any number of people who during the pandemic and in the aftermath of the pandemic start to reevaluate what they're doing with their lives. In addition to that, people say that the millennial generation and to some extent generation X or Z, whatever it is, are also sort of reconsidering a work-life balance. So you've had people leaving the jobs market. And actually, the biggest reduction, I believe, is not the younger people, it's older white males who are leaving the job market in larger numbers than other people. And so you've had some constraints on the supply of labor. You've also had supply constraints on labor due to the crackdown on immigration. The fact of the matter is not only agriculture, but also construction and a number of other industries were heavily dependent on immigrants to do the labor. And U.S. citizens have been reluctant to take those jobs. So you have supply issues on the labor side, and then you also have the demand side, which is again, like if you just look at the tech sector, you're seeing layoffs at the largest techs, and you're seeing some hiring in smaller techs, but you're not necessarily seeing all those people say, I'm immediately going to go to a smaller company. A lot of them are taking time off to reevaluate their lives, if you will. So I think that there's a variety of factors going on there, including automation of a lot of services. It's a very complex transitory period for jobs right now.
So automation has an inflationary or deflationary impact on wages?
Automation has a deflationary impact on wages.
Is that a long-term or a short-term trend, you think?
Both. But it's definitely, the Fed and CPM Group and other mainstream economists have been talking about the potential deflationary, or disinflationary, if not outright deflationary consequences of a long-term surplus labor market.
On the Russia-Ukraine war, which you highlighted as a potential risk to higher inflation, can you explain your logic there? The war has been raging for more than a year now. What's the direct link to U.S. inflation?
Well, there's several things. One is food prices. Another one is energy prices. And the third one is constraints on manufacturing, because we have really been spending a lot of money sending armaments and other supplies to Ukraine, as have Western European countries, and that stuff needs to be replaced. And so what you're seeing is tight supplies in some of the manufacturing industries that service the war machine, if you will. And that's going to probably have inflationary pressures going forward, unless, of course, the war ends.
Right. Okay. Now, I noticed in your report you did not explicitly comment on declining commodities prices as a factor for lower inflation later this year. Raw commodities that are inputs for construction or energy have all fallen. I'm talking about lumber, copper, natural gas, and a few others. These forces, are they likely to persist, Jeff?
When it comes to commodities, which is our forte, we take a rifle shot for each commodity as opposed to a shotgun view. So yeah, lumber prices have already come off. They've kind of stabilized. They shot way up during the pandemic and lockdown. They've come off significantly, but they're still high. We think there's probably some scope for further weakness. Copper prices have come off, but we don't think that they're going to fall significantly further from where we are. Other metals, I think that we mostly have a mixed bag on them. Some, aluminum we see, I think, moving sideways. We're coming out with our base metals advisory, our monthly report that covers the 6 metals that are traded on the London Metal Exchange. We're coming out with our base metals advisory for June today. So I haven't seen the latest updates of our projections, but we have been sort of saying, sideways for aluminum, and then, a couple of the other metals possibly down, nickel, and then a couple metals possibly higher.
And which of these metals, generally speaking, have the most impact on headline CPI overall?
Well, copper and aluminum are the largest metals among the base metals. You know, steel, obviously, we don't look at steel per se. I mean, we do look at steel because we look at molybdenum and tungsten and vanadium and other metals that are used in ferroalloys. But steel, obviously, is the biggest one to look at.
I'd like to talk about copper for just a minute now. I'm hearing two sides of this debate on the outlook for copper price. One is that the electrification story is going to push up demand for copper over the next few years. This is more of a long-term trend. The other one is that if you take a look at China's economy, the last month they reported numbers that were lower in terms of growth numbers, lower than expectation. In fact, now there's rumors of stimulus from the Chinese central bank. So certainly things aren't looking great in terms of growth. That may weigh down on consumption of copper and other base metals. And as you know, China has been the largest consumer of copper globally. So what is a stronger force, Chinese demand or the electrification story?
Well, on a short term, I mean, you've got to unbundle this. So you've got different boxes here. One is short term versus long term. One is China versus the rest of the world. China. But to answer your question very simply, weaker Chinese demand for copper is a short-term immediate issue that has a greater influence on copper prices than the long-term electrification needs requirements for copper. Now, copper prices have been bulled higher, probably more than they should have been, by people who were overly enthusiastic about the amount of copper that's going to be needed for a long-term electrification shift. And all kinds of commentaries that there's not going to be enough copper there. So that is dissipating to some extent because people are sort of saying, wait a second, I thought that, copper prices were going to go to $1,000 or whatever because of the energy transition. And the energy transition, is a long-term issue. The shortages of copper lie years forward, even if there are shortages. There are questions, we've been trying to find the time to really update our long-term copper projections. And part of that has to do with the long-term supply of copper, which I think is grossly understated by some people who market copper mining companies. But if you're talking about where the price is now and where it's going to be over the next 6 months, it's real economic activity in China, the second largest economy, in the United States, the world's largest economy, in Europe and in India, and really around the world. And there, what you see, China's having some weakness, but most of the other parts of the world are seeing some pretty strong growth. And then again, if we did see a cessation of the Russian invasion of Ukraine is going to have an enormous demand for steel, copper, aluminum, cement for the reconstruction period, whenever that starts. But that's probably beyond 2023.
We know that there's a relationship between the dollar and gold. We'll talk about gold in just a minute. Is there a direct relationship between the dollar and base metals? Take copper, for example.
The relationship is it's less positive. It's less correlated than gold, but there is one because most of the base metals are traded in US dollars. So stronger US dollar makes these metals more expensive for fabricators outside of the United States. So when you see a stronger US dollar, you'll tend to see that have some weakening influence on base metal prices and steel prices. And then when you see a weaker US dollar, that will tend to be have some strengthening capacity in commodities. And it's partly reality, but it's partly the fact that you have a lot of commodities trading entities, institutional investors and trading companies and others who will trade base metals based on the dollar. So if they see a rising dollar, they'll sell the commodities in the LME. And if they see a falling dollar, they'll buy the commodities. So part of it is a self-fulfilling prophecy on the part of the futures markets participants, as opposed to the actual direct economic consequences.
All right, let's move on to gold. In your gold yearbook that came out earlier this year, in your paragraph on equity markets, you had said that equity markets are vulnerable to further weakness, and you've outlined a few reasons as to why. Part of it is due to the fact that the markets are expecting looser monetary policy by the second half of the year. Now, you wrote that if the equity markets do see a correction, this could be beneficial to gold prices this year, you wrote. I'm wondering why people would flock to gold in a high interest rate environment. Wouldn't people go to a yielding asset like bond for safety?
Well, it depends on how you define a high interest rate environment. A lot of people look at real interest rates, and with inflation running around 5% and interest rates running around 5%, you don't necessarily have high interest rates on a real inflation adjusted basis. You are seeing people move into treasuries because they are willing to accept the rates as they are. And that is distracting some investment flows from gold. Another thing is the same thing that I was just talking about with LME metals, base metal prices. You have a lot of self-fulfilling prophecies. You have a lot of shorter-term investors and traders who will trade gold against the stock market. The correlation is actually, I think, historically, it's like negative 4%. And there are vast periods of time where the correlation's zero. But that said, what will happen is if interest rates, for example, rise, that will have effects on valuation models in the stock market. Institutional investors and others will pull money out of the stock market, and they'll say, where am I going to park it? Now, right now, and last year and this year, one of the best places to park it is treasuries, U.S. T-bills. And you're seeing a lot of that there. But you also, last year and again this year, seeing some of that money parked in gold and silver.
In terms of gold demand from central banks, tell us about the Chinese central bank story. You're telling me offline they've been purchasing a lot of gold. First of all, where are you seeing this data? And second, what does this mean?
Well, the People's Bank of China reports its gold monetary reserves to the IMF on a monthly basis. And there are people who say, well, they stopped reporting, back in 2015 or whatever. And that's not actually true. They continued to report, but what they reported was, hey, we're not buying any gold right now. And, there was a big period of time from like 2015 into 2018 when the People's Bank of China stopped buying gold and adding it to its monetary reserves. It started buying again in late 2018 when the gold price was trading 1,200 to 1,350. And they bought into the first half of 2019 when the gold price was low. By the middle of 2019, the gold price broke over 1,350 and it made a run quickly to $1,600, and the People's Bank stood down. And they hadn't bought gold from the middle of 2019 until November of last year. Now, bought gold and added it to its monetary reserves, to be accurate. Now, the People's Bank, like other central banks in many countries, will serve as a gold agent. People who have gold within China will say, I want to sell this gold and I'm not finding ready buyers. People's Bank of China, will you find a buyer for it? Us. And other people will say, I want to buy gold, and they'll buy it from the People's Bank. So the People's Bank has its monetary reserves, and then it has a side pocket or a side bucket, which is trading gold. And they'll take that gold in. Now, what we saw last year in China, first quarter of 2022 was very strong demand for gold. Second through fourth quarters, you saw very weak demand for gold. And there was a lot of gold that was coming into the Chinese market from domestic refiners and from investors who were disenchanted, and from wholesalers and retailers of investment products and jewelry who were not finding buyers for their gold. And the government of China has a policy, Chinese gold should stay in China. So if you are going to sell gold, find a Chinese buyer. And from April until November of last year, you weren't finding Chinese buyers. And the amount of gold demand within China in some markets fell 75% last year. So there was a lot of gold, and a lot of that gold was then handed over to the People's Bank of China. Please sell this for us. And the estimates are that they had about 10 million ounces of gold in that side bucket for sale. Now, by November 9th, I believe it was, the price of gold had fallen to 1624. People's Bank of China said, okay, we haven't been buying gold since the price got over 1350 in 2019. It's not back to 1350, but it was over $2,000 in early 2022, and now it's 1624. It looks like this might be the base. We're sitting on 10 million ounces of gold or so that people have asked us to sell into the Chinese market. Let's buy 1 million ounces. So they bought 1 million ounces in November. They bought 1 million ounces in December. They bought 600,000, 700,000 ounces per month, January, February, March, April, and I believe again in May. So
have they sold any gold?
Not during this period of time. Well, they've been selling gold from that side pocket. Because not only did they start buying, one of the reasons why they decided to start buying was when the price got that low at 1,600 in November, other Chinese entities started buying gold again, as did entities in the United States, North America, in Europe. At 1,600, a lot of people around the world said, hey, I'll buy gold at 1,600. I wasn't going to buy it at $2,000 in the first quarter, but at 1,600, given where we are in the world and the fourth quarter of 2022, I'll start buying gold. So the People's Bank of China and other people started seeing people buying gold. And again, they're the buyer and seller of last resort, if you will, in China. So when people started buying gold in China, they saw that buying first, right? They were the first place that somebody called and said, hey, I've decided I want to start buying gold again. So the bottom line is, it's great that the People's Bank of China is buying gold and that it thinks $1,600, $1,700, $1,800 are good prices to buy it at. But you have to understand that insofar as it's bought, I'm trying to 3.5, 4.5, 5.5. I think they bought about 5.5 or 6 million ounces so far. Insofar as they bought that, partly it was a reflection of them saying these are decent prices to start buying gold again, but it was also a reflection of an enormous weakness for demand for gold in the private sector in China. And people who talk about this tremendous demand for gold from the People's Bank of China are kind of glossing over the fact that one of the reasons they were buying it was because until November, December of last year, other people didn't want it.
I can't help but notice that all of this, what you're describing, has happened coincidentally with the rise in the gold price this year. Coincidence or causation?
Yes. Why is the price of gold $1,913 today? Because people are willing to buy and sell it. Why was it $250 in 2000? Because no one wanted it.
I've been reading in the comments. People. It seems that gold investors or people interested in gold are frustrated at the central bank buying gold narrative story, whatever you want to call it, because they say it's been happening for years. We still haven't seen gold to new all-time highs yet. So clearly there's no relationship, or we shouldn't even care. It doesn't matter.
Gold prices have been setting new highs for the last 2 or 3 years.
In other currencies, you mean?
No, in the US dollar. I mean, we saw a record high gold price earlier this year on an intraday basis, $2,084 or something. That was a record high gold price. It wasn't $30,000 the way the snake oil salesmen tell you, but it was a high price. But the other thing that you have to remember, and this is something we've been writing about for decades, central banks are much more price sensitive or price elastic than are private investors. And it goes back to what when you ask causation or coincidence, investors tend to chase the price high. When the gold price is high, they start buying. And this goes to actually the one thing that I thought that we should talk about today, which I'll get to. Central banks buy when the gold price is low. When private investors say, "Oh, the gold price is so low, I don't want to buy it," gold is dead, whatever. Then the central banks come in and buy it. They don't like to buy into a rising market, but private investors do. Now, the point I was thinking about making, which is, I guess, the most important thing I could tell your viewers. CPM Group has been saying that we thought the gold price would fall into June, July, August, maybe September, and then start rising again. From a short-term investor's perspective, that means don't buy. From a long-term investor's perspective, that means get ready to buy, because this is going to be your opportunity. We don't think the price is going back to 1620 the way it did last November, but we do think that the price has been weakening since the first quarter and for a variety of reasons. And we do think that the price will continue to be weak for the next 2 months. And from a long-term investor's perspective, this is a buying opportunity.
Is it true that gold, from a long-term perspective, is always a buying opportunity? I ask this because, as you know, I've been interviewing people in the gold space for many years already, and I've never once in my career so far heard someone say to me, from a long-term perspective, gold is not a good value. So, is there any thesis behind the argument that gold at some point is not of sufficient value to be buying?
Well, it depends on your perspective, and you're talking about the long term.
Right.
And, it's funny because our video today, Friday, is why I always own gold and silver. And It's like, I will have an investment portfolio that I buy and sell. And, from 1980, the first day I started at J. Aaron in December of 1980, the head of trading came into my office and said, "What do you think? Is gold a buy?" And I said, "No, it's a sell." And it was down to about 600 at that time. Anyway, I will always have an amount of gold and silver that is a physical, and it's my long-term insurance and portfolio diversifier. And it's not that I necessarily at all times see it as cheap and likely to rise in value, but I want that long-term insurance. But there's other portions of my investments in gold and silver where when I see the price rise to $2,000 on a spike for reasons that I see as very transitory, I'll sell. And then I'll buy back when I see the price at 1,800. We're teetering over 1,900. CPM Group's expectation is the price is going to fall below 1,900 over the course of the next 2 months. And that's probably, and we've been telling our clients for months, if you see the gold price below 1,900 in the summer, that's probably a good buying time.
Your predictions for the gold price have been very accurate there thus far. So, you're expecting some weakness in the summer and then higher price. I should clarify, what I meant was the people in the commodity space that I've interviewed have usually been long-term bullish on gold. It's the Bitcoin maxis that have always hated gold, and so they've never told me at any point to buy gold. But I should clarify that distinction there. Finally, I want to touch on platinum very quickly. You have a platinum yearbook coming out, which people should check out. I'll put a link in the description down below. So the drivers of platinum. Let's talk about short-term drivers. We've heard the EV story before. What's been driving the price in the short term?
Well, the short term has been driven by several factors. One, weaker auto sales, and as you said, loss of market share to the electric vehicles. But another thing is you had seen the platinum price strengthen in the first half of this year because there were a lot of concerns about supply disruptions from South Africa. There were electricity issues, there were water supply issues, And so you had some short-term concerns about supply disruptions within South Africa. You had longer-term issues because the South African industry has been underinvested in for several years. So there's expectation that at some point in the next 3 to 5 years, you will see a sharp decline in platinum production within South Africa. And then you also have the ongoing issues of platinum supplies from Russia, which is at war. And the platinum exports have not had any sanctions or restrictions placed on them, but there are restrictions in getting capital and supplies for the platinum mining and refining industry, which have reduced Russian supplies somewhat over the last 18 months and probably will continue to constrain the ability to produce and export platinum from Russia. So earlier this year, you had a lot of people getting more interested in platinum, but the short-term South African supply concerns have dissipated. And that's among investors and traders. It's not necessarily among auto companies or anything. It's really investors and traders who have looked at it and they were buying platinum because they saw the potential for a supply disruption because of electricity problems in South Africa. And now they're backing away from that. And that's one of the short-term factors driving platinum prices down.
Well, we do have to comment on EVs. Now, several years ago when I first started interviewing you, that the EV story was less of a pressing matter than it is now. Many automakers are pushing to have an all-electric fleet by 2030. That is their goal. It's not just Tesla, it's across the board. This is not that far away, Jeff. The PGMs are going to see significant pressure, will they not, because of a lack of demand for catalytic converters?
Our expectations is that 2030 is a aspirational goal. And, we look at the International Energy Agency, we use what they call their STEPS scenario, which is not what's the aspiration to be all electric by 2030, what's the realistic expectation, which is that by 2050, half of the vehicles will still be burning petroleum products, and petroleum will still be the largest source of energy for humankind by 2050. So we do see continued market growth in electric vehicles, deteriorating the total amount of PGMs being used in vehicle catalytic converters, but we see it as a much slower transition.
I'm curious as to why you think it's an aspiration and not a realistic goal. I'm just going to quote one automaker. For example, I was just looking at an ad. Audi wants to make all their cars electric by 2030. That's their stated mission. What would hold them back from achieving that goal? Is it a supply chain issue? Certainly not regulatory. Regulations are on their side.
It's several things. And first off, I'm not familiar with Audi's comment, but I know with other auto companies, they say we want our cars electrified by 2030. And then when you look at it, it's like they're talking about hybrids. And hybrids actually use more PGMs than non-hybrid internal combustion engine vehicles because of the start-stop, cold start that they have with hybrids. But I don't know about Audi. But if you look at the projections for the growth in electric vehicle production, supply chain is definitely a problem. High purity manganese, high purity cobalt sulfate, high purity nickel sulfate, rare earths. And you should ask me about rare earths yet in this interview, because we just put out a tweet that was kind of interesting about that one. But it's not just the chemicals, it's the manufacturing capacity. People look at all of the capacity to make the batteries, and there's this tremendous amount of battery factory construction going on worldwide. But they don't look at what they call the pre-cam, which is the cathode active material manufacturing. Pre-cam hasn't seen the kind of investment, and nor have the cathode active material manufacturing things. So there are supply constraints there. There are supply constraints on motors. There are, we built about 12 million electric vehicle motors last year, built about 12 million more this year. But if you're going to be 100% electric by 2030, you need to have motor factories using rare earth magnets, maybe not. You're going to have 100 million. You're going to have the ability to build 100 million motors. It's not there. And the capital to build those factories not there. But then it's not just supply, it's also demand. Right now, electric vehicles in Europe and the United States cost 50% more than conventional powered vehicles. So you're starting to see that. And you're also starting to see consumers realize that with electric vehicles, they're not clean environmentally, and they don't necessarily help carbon dioxide emissions because you still need to burn coal or natural gas or petroleum to generate the electricity to power them. So you're starting to see consumers say, wait a second, electric vehicles. Interestingly, Toyota has been working on a hydrogen engine, which is something that I personally have been an enthusiast for all along. Even when I wrote the book on electric vehicles back in 1979, hydrogen engines are very interesting.
Wait,
and Toyota
where can we read this book? I didn't realize you wrote this book, Jeff. Is that out online?
Amazon has a couple copies.
All right.
It's a collector's item now. World Guide to Battery Powered Road Transportation from 1979. Electric vehicles. Yeah. I was doing energy and energy technology research before I got into metals back in the 70s. But Toyota is now pivoting to hydrogen engines, and they've developed an 8-cylinder hydrogen engine. And hydrogen engines are like the worst dream for PGMs because they're not fuel cells, they don't use platinum, and they don't burn hydrocarbons. They burn hydrogen, and their exhaust is water. So Toyota is saying, look, we're not throwing away our electric vehicles. We have a dominant position in electric vehicles. And we're not throwing away our fuel cell test work. We're not throwing away any of our alternative energy technologies. But the diamond in the sky has always been hydrogen engines. And we've just made some fabulous breakthroughs. And it's not just Toyota. BMW has been working on hydrogen engines since the 80s or 90s, as has Ford, as have other companies.
Yeah, what I'd like to know is what people are going to do to scale up construction of charging stations. That's going to be a bottleneck as well.
It's estimated that it would take something like $50 trillion to build a network of charging stations to supply electricity to the United States vehicle industry. $50 trillion, I mean,
over a period
Biden
of
might
time.
say, "Hey, I can spend that. I can spend that," but it's a lot of money.
One final question: Have you looked into solar panel cars? People are looking into that too. Automakers are looking into that. That would solve a lot of problems.
It's interesting. One of the more interesting things are, not so much in the United States, but in other parts of the world, especially like in South Africa and Australia, where they have a tremendous amount of sun, they have patio covers over their parking lots because the cars get too hot. And what you're seeing increasingly is people are putting solar panels on top of those patio covers on parking lots to generate electricity that can be stored and used to power electric vehicles or other uses. Yeah, the best thing is that somebody sent me, I think you're still in British Columbia. Someone sent me a photograph of a British Columbia charging station at a road stop in British Columbia. And it was a electric vehicle charging unit, and behind it was a diesel generator.
I've seen that. That's a backup generator.
Yeah.
Yeah.
Right.
Yeah. I've seen a solar powered charging station for one single vehicle with a panel and then a backup generator in case it fails.
Yeah.
No, I'm talking about solar panels on the car roof. I've seen some concept vehicles out already.
It's something that even back in the 70s people were doing, and they have these gigantic rooftop solar panels. It's hard to say how it's going to go. I can't imagine that you would be able to generate sufficient electricity to charge a vehicle, uh, except in the hottest place, Arizona and Southern California, you might be able to do that. But the power generating capacity of solar panels right now probably is insufficient for an electric car.
All right. Well, finally, where can people learn more about your work and the research that you do?
www.cpmgroup.com. That's our website. You can download various free reads and videos and things like that. We have twice weekly videos on YouTube. But at cpmgroup.com, you can read about our reports. You can order our gold and silver yearbooks, which are out for 2023. You can pre-order our platinum yearbook, which comes out in the 25th of July. And you can read about some of our other research reports and consulting services.
And special for this video, there is a discount code, which I'll put in the description down below. So if you enter that code, you should get a discount for ordering these yearbooks. Thank you very much, Jeff. I appreciate your time today.
It's always a pleasure.
Thank you for watching. Don't forget to subscribe.